Good evening. Welcome to everyone joining. We'll just give it a few seconds just to welcome everyone in. Make sure we've got as many people here as possible for the start. And then Graham and I have got a lot of things we want to talk about. So we'll get going as soon as possible. Good to see where you're all coming in from. Portland, Oregon leaps out as the most exotic so far. Cool. We will get going. Welcome everyone to this evening's webinar, Stock Market Sector Trends for 2025. Obviously, there's been a fair amount in the news in the last month, really. It's like last 3 weeks. A lot of stock market goings on, a lot to talk about. So get your questions in. Just a quick disclaimer before we get going. This is obviously not advice, as always. Stocks can go down as well as up, and make sure you do your own research. I'm Megan Boxall, and this evening I'm joined by Graham Neary, who has joined us full-time at Stockopedia in the last month. Back full-time, having been full-time before, had a hiatus as a part-time, and now back. So great to have Graham back on board. Thank you for joining this evening.
Yeah, pleasure to be here, and hello to everybody in the chat. Great to see so many on board tonight.
So just a quick agenda for this evening. Graham and I have done a fair amount of companies coverage in the last few weeks, and there's definitely some big trends that are coming out of some of the company announcements, both in the UK and overseas. So we've tried to group these into, we've got 4 key groups that we're going to talk about this evening. So the first is the UK budget, the main story of which really from a company's perspective is the increase in national insurance and the minimum wage and the fallout that we've seen in the retail and hospitality sector. Quite a few companies now starting to say that this is going to cause a bit of a problem with their numbers. Potentially some opportunities, potentially in automation, elsewhere. So Graham's going to take the lead on that topic. Second up, President-elect Trump and his protectionist policies in the US. Not great news for UK exporters to the US. Sorry, that bullet point is a bit misleading. But potentially good for domestic growth within the US. So going to try and look at some companies on both sides of the coin there. Defense, big topic, has been a big topic for a while, but becomes even bigger in the wake of the presidential election, and also the Ministry of Defense spending review, which is set to happen in the UK. And then deregulation in the US. We had the announcement from the Department of Justice yesterday about Alphabet, but no one really seems to care that much when Donald Trump is on his way in and plans to reduce the red tape. So, yeah, those are our 4 big sectors. Most of you have seen the chat room on the side there. So get your questions in about all of those sectors, and Graham and I will do our best to answer as many as we can. We've got Lawrence with us in the chat room, so he can help you with any questions you have about the system. Graham and I will try and answer as many of your market questions as possible. So just to kick off, I've got a couple of slides. First one here, it's still not looking great to be a UK investor. The UK, the FTSE is the red line there, which has been the worst performer of all the markets that are in this slide. So the stocks is yellow, the Japanese Nikkei is green, and the S&P is blue, riding nice and high. Market response to the budget. So the budget was obviously on the 30th of October. We saw a big spike in AIM on the day of the budget, but both the AIM and the FTSE have trailed off a little bit since then. And in the US, the big stimulus was the election of Donald Trump on the 6th of November. Big spike in the S&P 500 after the election. A little bit of a tail off since then, but still doing very well. So on to the first of our topics. Graham, national insurance. What's going on?
Yeah, so thank you for the slide there. I thought before I get into a few companies, I just remind people what all the fuss is about and why it's such a big deal. Apparently, according to the industry, at least, we've been discussing this in the report on in our daily report for a few weeks now. There's a change in the rate of employers' national insurance, and there's a change in the threshold. Hospitality chiefs have been warning of carnage. There's been a letter to the Chancellor from UK Hospitality saying that it will cost £3.4 billion a year, along with the change to the minimum wage. It's the change in the threshold which seems to be possibly the most controversial part of it. Both financially, the threshold change is considered 4 times bigger than the cost of the new rate. So the threshold is far more impactful in terms of the increased financial cost. And then in terms of how it impacts people, it impacts a lot of part-time workers. So UK Hospitality said that in order to pass on the cost, they would have to raise prices by 6 to 8%, which is obviously not realistic, I would say, given cost of living pressures. So without raising prices, that means less investment. Now, of course, UK Hospitality is by definition a vested interest. The government has its own point of view that they need the £24 billion estimated. And in terms of the overall impact on the economy, the OBR said that it would hit economic output by 0.1% and increase CPI by 0.2%. And those aren't huge changes, I guess, for £24 billion of additional income. So that's the big picture. In terms of specific companies, we have had a lot of companies estimating the impact. So I thought I would just go through some of them with you. I'll see if I can share my screen. So we've got Churchill China there. That was quite interesting. This is a maker of crockery, tableware, and it's interesting because not only are their customers struggling or predicting that they will struggle under the national insurance change, but Churchill China itself says that it's going to have a big price to pay. So that had a very, very severe profit warning, and those shares have really tanked, which is quite unfortunate. That's a stock that I really liked, and I still like the company, but it's really as if hospitality didn't have enough to deal with the very high inflation and the cost of living crisis, and now a tax increase. You can see the market has spoken there and really tanked the shares of Churchill China, but it's still a company I really admire. Moving away from hospitality, we've got other sort of labor-intensive businesses like Begbie's Trainer, nearly 1,000 employees. Now, these employees are quite well paid, I would say, on average, but still, when you have nearly 1,000 employees and a labor-intensive business, you're going to have a big impact from a change to employers' national insurance rate. So they estimated it would cost them £1.25 million a year. And that cost their adjusted PBT estimate, so their profit estimate, their pre-tax profit estimate, was reduced by the full amount of that higher national insurance rate, which basically meant they got a 5% cut to their pre-tax profit estimate. And I think that's actually on the low side compared to other labor-intensive and low-margin businesses. So if you want to say what's the main takeaway from this whole episode, I would say it's that the lower margin, labor-intensive businesses are the ones that are obviously getting the biggest hit. And if you didn't own too many of them in your portfolio before this news, maybe you've not been affected too badly. So it's kind of a warning about, when you have these types of businesses, small changes in costs can make a really big difference to profitability. So Churchill didn't quantify how much the hit would cost them, and that may have exacerbated the profit warning because a lot of us were left in the dark over how much it would cost. Begbie's did quantify it, and that was a £1 million or 5% reduction in profits. In the case of castings, which is again a different type of business, a more industrial type of business, they estimated a £1 million cut. So that takes their pre-tax profit from 13 million to 12 million. So again, a decent percentage cut in profits. Serco, they estimated, and that's a big company, they estimated that it would cost, they estimated that it would cost £20 million a year. And they were expected to earn £280 million of operating profit. So a £20 million cost from national insurance, it's not quite 10%, but it is a decent chunk of their profits that's lost to higher national insurance. And that's another example of a fairly low margin business. And so that is a big problem for them in terms of it's a meaningful percentage of their profits that's lost.
Yeah, so I guess that the meaningful percentage of the profits is a really significant thing, and looking for companies with those narrower margins, because they're the ones that are really going to be worst affected. I guess the other thing to look for is companies that can't push these extra costs onto their customers and others. And I guess that's what we saw with Churchill China, because a lot of their customers are companies in the hospitality industry, which are suffering the same cost increases.
Absolutely, yeah. We've got Kitwave, for example. That's a food wholesaler. That's one where they can try to pass it on, but there's already reasonable amount of inflation there in food, and that was again about nearly 10% of their profits wiped out by the national insurance change. More example, we've got JD Wetherspoon and Marks and Spencers, where they were very, very large percentages of their total profits being lost potentially, unless they can mitigate it.
Marks and Spencer is such a massive company, and for a company like that to be saying this is actually going to have a very big impact, it is a little bit worrying. But away from the negative side of things, are there any opportunities here? I guess either in companies that have been oversold or in companies that have got that ability to pass on these additional costs or change the way that they pay for stuff.
Well, maybe you're best place to answer that, because my approach is more just to avoid the sector. So maybe you've got a more
The best way of
sophisticated strategy.
making money in the stock market is not to lose it. I am interested in the companies that have potentially been oversold. I've just seen a comment. I've now lost it. Whitbread is one. So if the share price is starting to really price in the cost of these national insurance increases, they might be overpricing, as you say, with Churchill China. They didn't actually put a figure on what the cost would be, and if it doesn't turn out to be quite as bad as expected, there might be an opportunity there. I think there are others as well that maybe can change the way that they spend on staff. And look at alternatives. I mean, we're going to go on to talk about automation and AI in the context of what's happening in the US, but we've seen that companies in the hospitality sector can use AI more than staff. One that I think is potentially quite interesting there is Greggs. I really like Greggs. I think it's a really good company. It does have a lot of staff, and a lot of these staff are the part-time staff who are on minimum wage, and the real increase in cost that's coming through the budget is going to affect a lot of Greggs staff. But there could be an opportunity there for a company like Greggs to stop using so many staff and start using self-service checkouts in a similar way to the way McDonald's does. Spending on tech rather than spending on people. I think there are definitely some things to be wary of. And I think those companies with the tightest of margins are probably the ones to be most cautious of. I mean,
I would say arguably it's been priced in some cases, but then, in cases where it's only a 10% hit to profits and the share price has fallen by 10% or more, then fair enough. So I think you can be selective. There may be cases where it's priced in, but there's other cases where it's not priced. There hasn't been a huge share price reaction, and the company says they will mitigate it, but it's not clear how they're going to do that. So that's where I'd say we need to be careful.
Just to go back to the slides here, this is Marks and Spencer's share price. Obviously, it's not had a bad year, Marks and Spencer, but the share price has fallen 4% since the budget. One of those companies that maybe is potentially being oversold, but if there's going to be an immediate impact on profits, then that's not a good thing. Let me just check to see if we have had any more specific questions about national insurance. This is I'm not sure if this is a bit of a left field one, but given the changes to national insurance, do you see opportunities in companies that give financial advice to both large and smaller companies? As another potential positive angle to this story.
Well, it's good for insolvency practitioners.
That's a depressing answer. Anything else in here? Card Factory is one that's come up. Mark and I talked about Card Factory in the last webinar that we did, but Graham, do you have any feelings about Card Factory?
Not particularly, no. I'd pass that one back to you in case you do.
Well, as a consumer, I think Card Factory is extraordinary. It's so cheap, and I never knew this until a Card Factory appeared on my high street relatively recently. And I think it's an interesting business, but it has got quite narrow margins. So yeah, I think potentially one of those to be a little bit wary of, because a lot of the staff are the part-time staff who are going to be swept up in these national insurance problems. So yes, one to be wary of for me. Okay, we will move on to the next topic, protectionism. So I'll just give a quick run through of what's happening here. So Obviously, Donald Trump has his America First mantra, and he's talked a lot about imposing tariffs, potentially up to 20% on all countries, but up to 60% on China and Mexico, and in some cases he's talking about 200% tariffs. He does make big sweeping statements, but he does tend to stick to them, even if not quite to the same level as he says in pre-election talks. But he did in his first term impose tariffs on about 10% of US imports. This has been met by a very positive reaction by the market in the US, because there was a bit of an assumption that these policies will be beneficial for US companies and for the US economies. Now, it is an interesting point because it's not actually always clear where the burden for tariffs like this lie. So it is actually the US importer that will pay the tariff. So, for example, a company like Diageo, a company, so let's say a bar is importing Captain Morgan's, it will be the bar in America that pays the tariff, and it is likely that said bar would pass those costs on to their customers, or look for another supplier. And I guess that's the thing that is worrying for UK companies that are big exporters to the US. Will they see a massive decline in demand? Question about how can we identify which stocks will benefit from Trump's tech protectionism. I'm going to go on to the potential benefiting ones. Going to stick with the ones that might be in a bad way to start off with, starting with Diageo. Diageo hadn't had a great year prior to the election of Donald Trump, but since the election, there's been an even sharper decline in the share price. Diageo is a big drinks company. I'm going to share my screen as well, just to get the stock report up. Diageo in the past has been a very high quality company, a decent growth company, but as you can see from the stock report here, the growth has slowed. I mean, revenue was down in the 2024 financial year and really isn't expected to be impressive in 2025 either. Scrolling down, operating margins are still pretty high. I mean, Diageo benefits from the strength of its brands, so there are higher barriers to entry than other companies in this sector. So that helps explain the nice high operating margins there. And return on capital employed as well, another sort of classic measure of quality, it tends to be pretty high. So an average of 15% over the last 5 years. So it is and it remains a high quality company, but investing in it does feel a little bit tricky when the growth is just not as impressive as it has been in the past, and what would potentially be justified by a typically high price to earnings ratio. Price to earnings ratio has fallen off a lot this year, owing largely to the big decline in the share price. But as you can see from the analyst consensus down here, that has been met by a massive decline in what analysts are expecting for both 2025, FY 2025 and FY 2026. So not looking great at Diageo, potentially in better value territory than it's been before. As I say, it has got some excellent brands, but a little bit dodgy at the moment, given the amount that it sells to the US. So just double check to make sure I get the figure exactly right. So 39% of revenues, so $81 billion, came from the US in FY 2024, and 52% of operating profits. The other sector of the market to maybe be a little bit wary of, given what's going on in the with the policies, is the pharmaceutical sector. So big pharma is typically a very large exporter to the US. The US healthcare market is great for big pharma, a lot better than other international markets. AstraZeneca and GSK are the two big pharmaceutical companies in the UK. This share price chart shows that AstraZeneca in the red there in particular didn't have a bad year, but there has been quite a big sell-off in both companies' share prices. AstraZeneca has come alongside some issues in China, which have sort of overlapped with the election of Donald Trump. But I think it's safe to say that there are concerns for companies in the sector like big pharma for the election of Trump and these protectionist policies. So AstraZeneca made $19.1 billion in the US out of $45 billion, so just under half. And GSK was actually just over half of its 2023 earnings. Vaccines and medicines were also two of the biggest exports from the UK to the US in 2023 in total, so equivalent to about $161 billion. But the other thing to note with big pharma is that the tariffs could also impact the domestic companies, because US pharmaceutical companies require a lot of imports for their research and development expenditure. So if research and development expenditure goes up, there might be issues for the domestic US pharmaceutical companies as well. So maybe not great for the sector as a whole, not just the companies in the UK. Another company which has had a pretty rough year is Spirax. Spirax makes about 30% of its revenue from the US. Now, the thing about Spirax, though, and this is something that is not quite clear, is that it actually has operating subsidiaries in the US, which might not be subject to the same tariffs as companies that are actually exporting from the UK to the US. So this is a share which I find quite sad, because Spirax used to just be the company that was held up as a symbol of high quality, and it has. I'm going to go back to showing my screen so I can show you the stock report. Spirax has struggled in the last year, struggled with growth, same sort of trajectory as Diageo, struggled more importantly with profits. Now, one of the issues around the company's profits is the fact that the debt position has increased massively. So you can see here, this was the last full year, £763 million worth of net debt, which is up from under 200 just a couple of years ago. So a huge increase in leverage has also come with a massive increase in interest costs, which has impacted profits. So Spirax has been a pretty terrible performer. It's still not that cheap either. A PE ratio of 20 times forecast earnings. It really isn't that cheap for a company that is just declining and declining. This analyst consensus, just like Diageo, just down and down and down. So maybe not one that's potentially not so much linked to the US situation. Could be some positives there if the economy starts to pick up in the US, because it does benefit from strength in the US. So if there are some signs of strength back in the US, where, as I say, it makes about a third of its revenue, there could be some opportunities to buy in at a lower price, if not a lower valuation. So one that I'm definitely keeping an eye on, because it has been a real high quality company in the past. But here, this is a real trigger warning for people who are potentially interested in Spirax. It's a falling star, which means that it has in the past been a high quality, high flying stock, but it's just on a downward trajectory. And Ed's written a lot about momentum in the last few weeks, and the falling momentum like this is definitely something to be wary of. And then just finally, some opportunities for companies looking to benefit from, or for investors looking to benefit from the Trump protectionism. I haven't got a slide for it. But my answer to that question is Ashtead. So Ashtead makes 85% of its revenue from the US. Share price has been rising. And there is a lot of talk about construction and the promise to invest more in construction. Ashtead provides rental equipment for construction markets, so it could be a big beneficiary. The tariffs don't impact Ashtead because it has a fully US-based subsidiary called Sunbelt Rentals. So it is a potential winner from the Trump presidency. Another company which had results this week, which were just, I mean, they were so good that I started writing in weird tenses because I was a bit excited, is Sage. Sage provides accounting software. And this is another company. So this is showing the signs of, well, tipping back towards high quality. So Sage historically has had a very, very high operating margin, and that had declined. Return on capital employed had also declined, which was all a little bit disappointing. But the results that were announced yesterday, so this hasn't updated yet, but when this updates, these numbers will all be a lot more appealing. And as I say, could be a beneficiary from the protectionist policies in the US. About 39% of its sales come from the US, and in the results that were announced yesterday, there was those US sales rose by 12%. So it's a provider of services rather than goods. So trade tariff troubles won't be so much of a problem. And the fact that there is appetite in the US for, US first, means that the small and medium-sized companies that Sage provides to could end up with more profits, more money to spend on the kind of accounting software that Sage provides. So I think that one's my pick of the bunch for this this particular policy. It is a fantastic company, and the results yesterday, as I say, were very, very good.
Well done.
Just having a look to see. We've had there are a few questions here. Higher US inflation and the strong dollar make foreign imports to the US cheaper or the same despite import tariffs. I mean, yeah, it's hard to say right now, but yes, obviously a strength in the dollar has a positive impact for companies that supply a lot in the US. So yeah, potentially some balancing out of the situation there, but yeah, at the moment it's probably a bit hard to tell. I think there is a general feeling about, should we switch into US stocks? Is this the time to turn our back on the UK? Graham, I don't know if you've got a view or a thought on that.
Yeah, so I see Peter mentions the quarterly reporting in the United States. I do think the reporting is a lot better, reporting standards. They're more frequent, more detailed. But on the other hand, that does mean that the UK market is in theory less efficient. So if you're willing to research, you should probably be doing better than the market in the UK because there is less information, especially for small companies. in terms of valuation and, I mean, the quality of the companies, clearly the US is driven now by the Magnificent Seven. I am a little bit worried. I was reading Lion Trust's commentary this morning, and I really agreed with what the CEO of Lion Trust was saying, that the passive boom is arguably a self-reinforcing cycle and is contributing to the outperformance of the Magnificent Seven and other huge stocks. So that does create a risk in terms of the concentration and overvaluation of those stocks. So I don't think you can just blindly buy the Magnificent Seven and expect to do well, because by conventional standards, some of them are very, very expensive, and historically that doesn't work out. So I still believe that in that you should look for value, and while I do really admire the quality of some of those magnificent companies like Alphabet. I was a shareholder in Alphabet for years. I wouldn't give up on the UK just because it's so cheap and because it's unloved right now. If you as readers from as Stockopedia subscribers may know, the stock ranks have had decent performance. My own list has had decent performance. My own discretionary list has had decent performance. So if you do work, if you look for value, look for quality in the UK, I think you can get decent performance. So that's my view.
Excellent. Shall we move on to defence? And actually, there is one question there that I would quite like to address, which I think falls into this theme. AIM. The question was from Lillian. What sort of future do you think AIM stocks have? How do you feel about that one?
I mean, there's a lot fewer AIM stocks now than there used to be. What's the statistic? Is the number down by 60% or something?
That much? I know it's down by a lot from its highs. It's 2020 highs.
But if you go back further than that, I think it was higher again.
Really?
So I wish I could remember that statistic off the top of my head, but the number of AIM stocks is dramatically lower than it used to be. But I don't think that means that AIM is going anywhere. As I wrote recently, the big problem was that in 2021, when AIM had a decent valuation, a lot of IPOs ended up, hitting the market that were overpriced, and the companies weren't great. And that's sort of the problem with AIM, is whenever it gets a decent valuation, it gets beaten down again with a whole wave of overpriced IPOs. So, if people can just avoid those IPOs, they're already at an advantage. I don't think AIM is going anywhere. The model seems pretty reasonable of self-regulation and a reasonably low cost of being listed. So it just requires a bit more work. But for people who want to pick a portfolio and have a little bit of time to run a screen or to do a bit of reading, I think it's fair game.
Mm-hmm. Okay, let's move on to defence now. So over to you again, Graham. What's the headlines?
Yeah, so I've been reading about the Strategic Defence Review, and the good news is that I think a lot of defence contractors are going to be fine. That's sort of my big picture conclusion. But in terms of the review itself, it is a short-term issue, and there is a feeling I think, in the industry, based on what I've been reading, that spending is under pressure. That government spending is not really where it could be or should be. So this strategic defense review was launched in July, very wide ranging, and it's going to address basically every aspect of defense. 54 billion pounds was spent on defense in the 2024 fiscal year. That was expected to increase to 57 billion in the current year. And there is an aspiration, or I should say a commitment, that defense spending in the UK should reach 2.5% of GDP. However, importantly, there is absolutely no time limit or deadline for that goal. I think that the Conservative government was targeting 2030 or 2031 for that goal. The Labour government has said they are still committed to the goal, but they have no specific time frame for it. So, the industry, I think, again, based on what I've been reading, they feel that there's not as much defense spending as there could have been or as there should be. The Defense Secretary, John Healey, says that the government has inherited finances that are far worse than it had anticipated, which I guess goes back to the national insurance issue. But I was reading a report from the Royal United Services Institute, which is a think tank that does a lot of work on defense procurement. And they said that there is a deficit running to the billions of pounds every year now, £4 billion deficit next year, another £1 billion deficit for pay settlements. So there is a feeling that defense spending is under pressure. But let's look at some specific companies. And I think if you look at specific companies, some of them, or most of them, seem to be doing fine so far. And they have a good track record of dealing with government spending that's constrained. So for my first one, I'd like to mention Kinetic. Get the screen up there. So Kinetic, a reasonably big company, 2.4 billion market cap. And what I thought was really impressive about what they said recently was they highlighted that their organic revenue has grown at broadly double the growth rate of national defense budgets over the last 5 years. So what that says to me is that maybe they are an example of a company that is differentiated and technologically advanced to such an extent that their success is somewhat insulated from defense spending constraints. So from their recent interim results, the revenue was up, orders were up. They have another £50 million going into buying back shares. So that's £150 million of buyback. They say they've got significant long-term visibility from their order pipeline and their backlog. And to give you an example of a UK contract that they do, or that they have, and 66% of their revenue is UK based. They have this laser weapon called Dragonfire, which is being deployed on Royal Navy warships from 2027. So this is really, really high tech machinery. And so that's an example where I think maybe they're so differentiated that a little bit of constraint from the budget is not a big issue for them. Now, to give a counterexample, and you covered this one, Megan, Solid State had a profit warning. So this is a small company, only £70 million market cap. 44% of their revenue is from defense, security, and NATO. And it's an electronics group. They recently blamed specifically the Strategic Defense Review for delays to orders that they had been expecting. So maybe that's an example of a company where they're not sufficiently differentiated in terms of their technology. Perhaps that's just an idea, or B, their orders are a bit more short term, so that when there are short term dips in activity in terms of defense orders, that hits them straight away. Whereas companies that are working on larger long-term orders are not affected so much. So that's just an idea I had about solid state. I don't know if you want to chime in on that.
Yeah, as you say, I had a look at this profit warning the other day. It was weird because it came like 4 days after, or 5 days after the company had actually announced its a trading update or results. It was clearly a surprise turnaround in the spending from the Ministry of Defence. So yeah, and I think, as you say, it's that overexposure to one customer, which is a bit of a risk. And actually, the other company in a similar sort of space that we saw results from this week was Avon Technologies, or Avon Protection, and they good results, but it's a similar sort of issue there, in that a lot of their revenue comes from one customer. In their case, it's the US Department of Defense, which is all fine when the Department of Defense is spending a lot, which it is at the moment. But if those, I think that sort of overexposure to just one customer is a risk, and it can be a risk when, as we saw with solid state. So I think for me in the defense space, Kinetic looks a bit more interesting. And we've just had a comment from Peter Wormsley, who likes BAE and Rolls-Royce, and I have to say I would agree with that. There's a little bit more differentiation both in the products and also the markets that they sell to. So slightly larger companies, maybe slightly safer bets there.
Yeah, I think I agree, and I know we're running quite long already, and we have another topic to discuss. So I'll just very briefly mention Chemring, which I think is an interesting stock. They produce explosives, flares, decoys, sensors, a lot of very high-tech stuff. And again, in their recent results, or their recent contract wins, they announced they were selling to Germany and the US. I think the UK is 43% of Chemring's revenue. I think they're okay in relation to the Strategic Defense Review. I could be wrong, but my impression is that they're diversified geographically, and the stuff they produce is quite advanced and quite necessary. So my impression is that they'll be okay. Obviously, I don't have a crystal ball. And then the last one I might mention is Cohort, where that's really a story about acquisitions. They announced another acquisition today, I think for £75 million, which is quite big for them. So I think that one is more about, do you agree with their acquisition strategy? Do you think they're good at acquisitions? That's a bigger question than the Strategic Defense Review. And I guess the long-term track record there is not bad. So suggesting that actually maybe they're quite good at what they do in terms of acquisitions, and that will carry on, hopefully. And in terms of British Aerospace and BAE, they announced a trading update the other day, leaving full year guidance unchanged. And I think they're very influential. They're so big, they have influence of their own. So I don't think I'd worry too much about them.
Yeah. Cool. So on to the last one of our topics. By the way, we'll share the slides at the end of the session, and there is a little bit more information about that, the breakdown of where those companies in the defense space make their money from. But the last topic is really about Tesla, because it feels like we can't not talk about what's happening in the markets without talking about Tesla. The overall story here is the deregulation story. The US antitrust laws, so the competition laws in the US, are quite old. They haven't been updated for a very long time, and they do really suit large companies, large technology companies. While during the Biden administration, there's been a few more steps to trying to regulate some of these companies a little bit more. We saw yesterday with the Department of Justice ruling on Alphabet. They're encouraging or suggesting Alphabet should be forced to split out Chrome. But Donald Trump is less keen on that sort of regulation, and he actually wants to make it easier and more supportive for big businesses like this to grow. So one of the areas he's interested in exploring is making it easier for companies to launch driverless vehicles. At the moment, the regulation around launching driverless vehicles need steering wheels, they need pedals, they need the types of components that a driver would need. But Donald Trump and his new sidekick, Elon Musk, want to remove that kind of red tape. They're also talking about watered down capital requirements for banks. We've seen the banking sector in the US do quite well, the investment banking sector in particular. And Donald Trump is putting the personnel in charge to help accelerate these kind of changes. So Elon Musk has been appointed as the head of a new government department called the Department of Government Efficiency. Lena Khan, who made a big name for herself when she was actually at Harvard, writing about antitrust and the antiquated antitrust rules in the US. She's currently the head of the Federal Trade Commission. She's likely to be removed. She's one of the louder voices for increased regulation around the US tech sector. Overall, the environment's looking quite positive for these massive companies. And I think it's just really interesting. I think, Graham, what you were saying earlier about this sort of dominance of these huge companies, I just can't see what upends them at the moment, unless I just don't know what's going to stop the gravy train. I think there was a lot of talk around during COVID that maybe that would be the coming of the end of this massive growth streak in the US. It hasn't happened. Companies are just reaching phenomenal highs. We had results from Nvidia last night. Obviously, big AI play, the biggest AI play, the biggest company in the world, biggest listed company in the world. And the shares cooled off a little bit after the numbers, but it's just keeping on going. But Tesla has been, I imagine, I'm not 100% sure about this, but I assume it is the biggest direct beneficiary of political goings on in the last month. The share price, which was flat on the year prior to the election of Donald Trump, is now up 36% since the election. It's been doing pretty well. Number of reasons for this. Firstly, obviously, Elon Musk is in the news every other day and has been given a large role to play in the incoming government. The thing that's, I think, a little bit interesting about this is that Donald Trump is obviously very, very anti-electric vehicles. And Tesla has historically been an electric vehicle company. Donald Trump has said that he may put tariffs on, he may remove the electric vehicle tax credits, which I think may seem like a negative thing for Tesla, which does actually make money from its electric vehicle tax credits, which it can sell to companies which don't hit their green targets. But the policy around electric vehicles could be beneficial for Tesla. Firstly, because there might be tariffs on foreign car makers, so that is leaves the US market a lot less competitive and a lot more open to Tesla. So Tesla's added a huge amount. It's about $300 billion to its market cap since the election, which is more than the combined market value of Ford, GM, and Stellantis, which is just unbelievable. And the other thing about the removal of the electric vehicle tax credits is that because it's so much more advanced than its peers in the rollout of electric vehicles, it's actually not reliant on those tax credits to manufacture and deliver profits from making electric cars. So the removal of the tax credits might hamper its competitors significantly more than it hampers Tesla. The other thing about this current market environment being beneficial for Tesla is that it isn't really pitching itself as an electric vehicle company anymore. And certainly Elon Musk, its founder and chief executive, sees it a lot more as an automation business. So, and that's why this new federal framework for self-driving cars, which don't require steering wheels, might help it a lot. So Tesla's got its Cybertruck and its robo-taxis, which it just can't get out into the market because there are too many regulatory hurdles for it to cross. It also, these autonomous vehicles don't have a great safety record. So I'd say it's a little bit terrifying, the removal of safety requirements to getting these autonomous vehicles on the roads. But it explains why Tesla's share price is doing so well at the moment.
Yeah, I mean, it can't hurt if your CEO is best friends with the president.
No, it really can't. Yeah, a few comments on this. Be wary of Tesla. EV demand has been crashing for a while worldwide. I think it's interesting. I think this speaks a lot to the way of investing in the US. And actually, I had a comment earlier where I wrote about NVIDIA this morning, and one of the comments from one of our readers said. So I said about how using traditional valuation metrics was futile when you're looking at a stock like NVIDIA. But the reader said he thinks we need to stay grounded in theoretical financial framework to prevent getting caught up in market emotion, which I think is a very valid point. But it's also very hard to do if you're investing in these big US tech companies, because if you're trying to stay grounded in financial theory, you're missing out, because you're not going to invest in a company that's trading on 60 times forecast earnings, no matter how high quality it is, or no matter how fast it's growing. There is no valuation argument to be made about some of these stocks. But we're seeing share price growth, and in NVIDIA's case, it's 200% in a year. Multiple expansion, the kind of metrics that we see for multi-baggers. But it's just a different way of investing, and it's a tricky way of investing, and potentially not a stock pickers market. Maybe that is more what the UK is good for.
Yeah, I mean, I have a few thoughts on Tesla. I mean, firstly, it will be very interesting if Trump puts tariffs on foreign automakers while he has Musk sort of whispering in his ear, because BYD to me is just Chinese Tesla. I think the cars look so similar. It's just a direct Chinese competitor for Tesla, and Trump might help to block them from making inroads. But the whole automation thing, I mean, this goes back a long way. I still don't believe that Tesla has solved autonomous driving. I know this is a controversial topic. I don't know if we should go over it, but I don't think they've done it.
Does anyone believe, apart from Elon Musk, that they've...
Well, some people believe it, but Alphabet has robo-taxis operating every day of the week with their Waymo subsidiary. So I mean, there are
also might benefit from reduced regulation, because there are restrictions currently on the amount of Waymo taxis that can drive every day. But that's potentially another thing that might go under the new policies.
Sure. Yeah. So, I mean, I don't currently hold any Alphabet shares. I did hold quite a few for quite a long time. So that, like, for me, Alphabet is where I go for autonomous driving and automation. Personally, I don't think Tesla has solved it, but I know Tesla bulls will tell me I'm wrong. But I guess we'll wait and see.
Yeah, I think one of the things that people talk about when they compare Waymo and Tesla is Tesla seems to have solved the software issues, while Waymo's sorted the hardware issues around autonomous vehicles. And people say, oh, the hardware issues are easier to solve, but I'm not sure necessarily how true that is. And I think Waymo Waymo, as you say, is literally doing it. It's got autonomous vehicles on the roads, which people can flag down like they would an Uber, which seems to be a little bit more advanced than what Tesla's doing, which is slightly dubious online videos of Tesla's doing tests which don't quite work. Or a question from Phil Moore: what are the chances of Trump and Musk falling out? That's a fun question. I think it'll be interesting to see over the next few years. So we've had an hour. Graham, are there any main takeaways from what you've been seeing in the markets and also from what we've talked about today?
Well, in terms of national insurance, for me, it's just another reminder that low margin businesses are vulnerable to small changes in their costs. It could be national insurance, it could be something else that hits them next year. So personally, I try to not hold too many low margin businesses, or to get them very cheaply if I do. In terms of defense, I think the defense companies are fine, most of them. The strategic defense review is important, but I don't think it's a huge problem. Those are my takeaways.
I guess for me, I love investing in the US, and I think that and I think that the kind of quality that's on offer there is so exciting. But even I'm a little bit wary of the optimism that has followed the election of Trump, and whether that's potentially slightly misplaced. So I think maybe being a little bit more cautious about what opportunities there are in the US, and maybe doing the kind of due diligence that investors typically are required to do on UK stocks. Like there could be opportunities there in the US among the slightly less well-known companies than those Magnificent Seven that dominate the market and dominate the headlines. And in the UK as well, for me, I think keeping on for me, looking for quality, which obviously shown in our stock ranks, the highest quality stocks, and increasingly momentum. And I think if there can be a change in sentiment around UK stocks, I think momentum has a big role to play. So could be opportunities in the UK, I think, for those who are willing to hunt. a question area that's really stood out to me this evening, which we won't talk about this evening, but it's about house builders. I think that's given us some useful thoughts about some future content. So look out for that. I think a lot of you are interested in the state of the house building market, given some of the political upheaval in the UK recently. So I'm sure we will find some time to get around to looking at that. But yes, thank you very much for everyone's questions and for coming along this evening. Thank you, Graham, for accompanying me, and hope to see a lot of you again on a future webinar.
Yeah, thanks for all the questions, and yeah, thanks for organising this, Megan.
Thanks, everyone. Have a good evening.
Yep.